putting aside what's going on in the macro picture at any point in time, there's a lot of arguments that have been put forward lately that the economy fundamentally has changed, partly because it's been engineered to the extent that it has.
Yeah.
And as a result, some of the dynamics that perhaps we relied on over time are no longer as reliable, and that even the market structure has changed. I would love to hear your thoughts on that, and what's the consequence of that if you agree that there are some fundamental changes.
Great questions. All right. So the biggest change to the economy is really, you could argue about it being kind of in three levels. Let's call the first one demographics, second one technology, third one debt. So when we think about the sustainable rate of the economy, we're going back to classic economics, which is the long-term sustainable rate and the rate of growth of the economy is a function of two things, which is growth in employment, the number of hours that are worked, and productivity. And so if you went back into the 1980s, I mean, we were growing the labor force at 2 to 3%, 4% per year. Productivity was kind of in the 3s and 4s. And so you could get, some pretty good, GDP numbers. So we were doing GDP numbers 4, 5, and 6% real. And in the 19, it started to slow because productivity was slowing. And that's still been a big mystery with all the technological advances. That productivity today is about 1.3%, something like that. The biggest problem is the labor force growth. Labor force growth now is 30 basis points today versus 3 and 4% 20 and 30 years ago. And so when you have productivity at 1.3, 1.4, and you have labor force growth, you're a sub 2% sustainable growth economy, and that's who we are. That's it. I can't make it go any more. Now, when investors see GDP numbers coming out on a quarter to quarter, that comes out of the Bureau of Labor and Economic Statistics, which basically they'll take consumer consumption, they'll take corporate expenditures, they'll take government expenditures and net changes in net exports, imports, to come up with a short-term measure of how the economy is doing. But it's very volatile. But if you go over 10 years, those four variables, consumer, corporate, government, net change, and imports, have a 0.96 correlation to what I just said was the sustainable growth rate of the economy is a function of labor force growth and productivity. The challenge that we have today is that we're just not growing our labor force anywhere near what we used to. As a matter of fact, if you kind of look at it, I don't want to get too far off the reservation. We need 2.1 babies per woman to have to basically offset our death rate in the United States. And right now, we're only producing 1.6 babies per woman. So our
1.06.
Our population shrinking. The only reason why we're
1.06, 1.06,
1.6, yeah. And we need 2.1. So our population is shrinking. If we didn't have immigration, and I know that's a very, very hot topic, but if we didn't have immigration, our population would be shrinking. And if you want to be in a bad economy, have a population that's shrinking. Ask Japan how that's working out, right? So the biggest change that's going on in the economy is that we're going to grow sub 2% on a sustainable basis over time, just because of that facts of the moment. So what does that mean? Well, that means that, despite the spike of inflation, which I would argue is manifested because of COVID and the stimulus problems and the disruption of the supply chains, once that clears the deck and we clear that, we'll probably be back to lower for longer. The only bugaboo would be, the debt problem. But debt is highly deflationary too, because you're reappointing your assets to paying down debt, not to productivity.
Right.
And technology being now the largest sector of the economy. Do you know that in 1975, we did a study on sideways markets in 1975. Technology in 1975 was the second smallest sector of the economy. Today, it's the largest. Well, what does technology do? It's a huge deflationary force. It brings prices down. So in my view, even though the mantra today is interest rates are going to be higher for longer, that may be for next year. We're really in an environment of lower for longer, lower economic growth, probably lower interest rates, lower inflation over time. And if that's kind of the canvas that you're working with, what then becomes a scarce resource is growth. I mean, if you can find something that can grow in that backdrop, the market will pay up for that scarce resource. And so that's kind of how we see the world largely and long term. Now,
Right.
whether that works out this month, next month, this quarter, next year, who knows? But that's kind of how we kind of perceive the world largely.
And how would you see the world in terms of the actual market structure and the participation of those in the market? Like any differences that you would see there?
No, big time. And I need to do more quantitative work on this, Mo, and it because it's so hard to get your hands wrapped around. It's not only been the rise of indexing, but the number of long only managers is declining. My fraternity.
Right.
The assets under management for long only managers is declining. Where are assets growing rapidly? Well, clearly still in indexing and ETFs, but it's in alternatives. It's certainly in the private equity space, venture capital space, where people are looking for returns higher than what they can get in index returns. And then it's, you know, the force that is coming on, and Michael Lewis and other people have written about this, and they've done a great job. And it's just the rise in the hedge fund community of what's called algorithmic quant-driven funds. They have the most money, and they're getting the most flows, and they lever those flows. So not only do they have a lot of money, they lever it up. And that impact of that group is having the biggest impact on day-to-day changes in stock prices. So as you know, Mo, you walk in one day and at 9:31, the screen turns instantly red. That's not me. Not the trust officer down the street. That's not a financial planner. That's not a bunch of brokers. That's guys within microseconds when the bell goes off have already made a bet that the algorithmic software has decided that if interest rates go up, short the Russell 1000 growth, and it happens instantaneously. So what we did in the money mining book was trying to tell people that when you look at the stock market, you can't look at it in just one dimension, that that you're playing a game with other like-minded people. And therefore, if the stock prices are going up, people must be in agreement with you. And if stock prices are going down, they must be in a disagreement with you.
Yeah.
The fact of the matter is there are multiple games being played by multiple players doing different things with a lot of money, sometimes with leverage. So prices are going all over the place, having nothing to do with your original investment thesis and having everything to do. I think it was what Oscar Wilde said, that we become a society that understands the price of everything and the value of nothing, which is the game today is arbitraging price and not as much on value. But I do believe in the weighing machine capabilities, because if the spreads get too far out of whack and you get too far undervalued, then the LBO market comes in, management buyouts, or somebody takes you out. So it does, you'll get reweighted on your economics over time,
Right.
for sure. But in the short run, there are multiple games being played by multiple players playing it's like you're playing poker and they're playing gin rummy over here, or playing blackjack and they're playing solid. Who knows, right? Just so many different games going on. And so there's another reason when you look at stock prices, you better be looking at something other than just price to get a judgment as to whether you're making progress or not. And then therefore we go back to the economics of what we own.